Good morning. I hope you all are very, very well. Welcome to the last webinar of 2023. I can't believe how fast this year has flown by. Only 19 more shopping days until Christmas. Today, we're doing things a little bit different. We're going to focus on the highlights of 2023, what stood out, what impacted the markets, what drove returns. And then I'm very excited to welcome our guest speaker for today, our Head of Manager Research, reminisce, who will be sharing her insights into the market over the last year, in particular our managers, our active managers, and what they're seeing and what they have seen over 2023. And then finally, we're going to share our positioning and our outlook for 2024. And at the same time, we're going to do a poll and find out what you think markets are going to do next year, various asset classes, various risks. And then right at the end, we'll share our insights with your views, and we'll compare them and see what everyone thinks is going to happen next year. Rinse, repeat, 2024, it all starts all over again. So let's start with the asset class reviews year to date. So this is 11 months to the end of November. And wow, those returns are phenomenal. Firstly, we have to exclude FANG because FANG distorts the market returns completely with its doubling, 100% return year to date. And very similar returns to the crypto market. Crypto markets also doubled year to date. If you've been lucky enough to be long crypto, you all know I'm not a crypto fan, so I'm certainly not one of those lucky people. But crypto has doubled this year, and that, along with FANG, has certainly been the best place to be in 2023. But even excluding that, market returns have been phenomenal. You look at the top line, world equities up 30% in rands. I mean, it really is an amazing return. Even in a normal year, 30% is a phenomenal return. But given what we've seen this year, we've had continuation of the Russia-Ukraine war. We've had the Fed pushing interest rates up in the fastest cycle since the 1990s, pushing mortgage rates to 2-decade highs. We've had war erupt in the Middle East. There's certainly been so much to worry about that these kind of returns really are something to be very grateful for and quite surprising, actually. Fortunately, we were long for most of the year. We were overweight risk from the end of last year, which worked well for us. The middle of the year, after markets rallied quite strongly ahead of inflation and the Fed, we cut to neutral. And then we reduced that underweight during this past month and took it back to neutral. Unfortunately, we have participated in the rally so far. Right now, we're sitting at a neutral position, and I'll explain exactly why and give you the details of what our next move is going to be at the end of the presentation. But still, I can't get over what a year it has been. Late 2022, the Bloomberg strategists' consensus return for the S&P 500 was minus 2%. S&P returned 21% in dollars. It's just a phenomenal return. Every asset class, as you can see on this chart, was up. China, the worst performer for the year, only up 2.6% in rands. South African equities close behind as second worst, 5.3% in rands. South African bonds, third worst, 6.8% in rands. So SA market certainly the place to not have been in 2023, only beaten by Chinese equities. So when we look back at 2023, it really has been a story of the Fed. And markets have played second fiddle to the Fed. Doesn't matter what war you were focused on or what else was happening. It really was all about global interest rates, global inflation, all driven by the Fed. And the Fed then had its own impact on asset class returns through the impact on the dollar and its impact on rest of world asset classes through tightening of financial conditions through US rates, tightening of financial conditions through the dollar, and everything else just moved as a result of that. And in 2023, we saw a good first half, as I said, and then markets were very concerned that inflation was going to get away and that the Fed would have to hike rates a lot further than expected. And the Fed hiked 5.25% from March 2022 to July 2023. Markets were concerned the Fed would have to carry on hiking even further. And that's why in August and September and October this year, markets pulled back about 10%. And then they rapidly recovered nearly all of that loss in November as markets realized the Fed was done with its hiking cycle and that inflation was under control, even though it's still high, but inflation was falling and the Fed wouldn't have to carry on hiking rates. So it's all really been about, the volatility has been driven very much by the Fed. And if you look within asset classes, those asset classes that have done worst have been those that are linked to US bonds, whether it's small caps that have underperformed because of high interest rate costs, and small caps generally have less cash on balance sheet and more debt, although it was bond proxies like staples and healthcare, utilities, property, all have done very poorly this year. So while the S&P 500 has done 20% in dollars, within that, it's been a very narrow focused market breadth, very much driven by tech stocks, by the FANG stocks driven by AI, but also, I think, more importantly, by the fact that they have those big, magnificent seven stocks have very strong balance sheets, very high cash levels, and high interest rates work in their favor because they earn very good interest income, unlike small caps which have to pay. So quite a year, 2023, dominated by the Fed, still all up to what the Fed does going forward in terms of the volatility. I don't think the Fed has stepped back from being the major player in the world, and geopolitical risks are certainly there, but secondary to the Fed. So key highlights for 2023, it really was about the Fed, as I've said. The market was expecting, at the beginning of 2023, the market was expecting global growth to slow to 2.1%, expecting global growth to slow to its slowest level since 2008, since the great financial crisis. If you look at the chart on the right there, you can see the purple line. Everyone expected a recession in 2023 in the US. It was the most anticipated recession of all time. Every economist that was polled said the US is going to go into recession in 2023. And it was early 2023, then it was mid-2023. And now, as you can see, that purple line has slowly moved down to zero. And the consensus and economists have begrudgingly had to admit that there's no recession in 2023 in the US. In fact, the US grew at nearly 5% quarter on quarter in the third quarter. So very far from a recession in the US. So the soft landing consensus, which is now, if you look at the green line, that has slowly risen from 20% up to 40%, still not consensus. Consensus is now, if you look at the blue line, close to 60%, according to JP Morgan, that we're going to see a US recession in 2024. So the can has just been kicked down the road. Everyone's still very conservative, still expecting a recession, but instead of a 2023 recession, it's become a 2024 recession. And I'll talk more about that in our outlook as well. And I look forward to hearing what you all say in the polls about when you think that recession is going to start. So it was very much driven by US interest rates and the fact that US interest rates work with the lag, and that's what's driven that consensus expectations for a recession this year and now next year. But what are some of the other highlights for 2023? Crypto markets, as I mentioned earlier, doubled in 2023. And that was attributed to a couple of things. Firstly, and we mustn't all forget, the US had a major banking crisis early on in this year. March of this year, there were a number of banks that defaulted in the US. There were some very big concerns that the US banking crisis would spread and become a global crisis. That didn't happen, but it certainly helped crypto markets as people lost faith in centralized traditional banking in the US. Not only that, but very high inflation levels and very high debt levels in the US has meant that investors have also questioned whether the US is following the correct monetary and fiscal policy, and those who think that the US is not being prudent are either buying gold or more likely crypto. And then most recently, and what caused the big jump in crypto has happened in the last 2 months, and that has been the increased likelihood of a spot US Bitcoin ETF. And the thinking there that once that ETF is in place, It'll give institutional investors very easy access, and huge flows will then follow that ETF. I'm not as sure whether there'll be that much flow into the ETF if it is launched. Not significant enough to move to double the price, but we will be watching that very, very closely. Certainly, we're watching within South Africa, and we do want to give our clients opportunity to follow with a crypto ETF as soon as South Africa is allowed to do that. We still, unfortunately, aren't. Yeah, I'm not promising it'll go into our balance funds, but we'll definitely have an option there for those of you who think it's a good place to be. Then the global energy transition, as we all know, as a result of the Russia-Ukraine war, there was a huge drive towards energy security. Europe in particular being forced to find alternative sources of energy away from Russia, and that led to a move away from fossil fuels to nuclear, to natural gas, to solar, to wind, renewables in particular, and that whole transition was only speeded up by the tensions that have risen in the Middle East, amongst concerns that Iran might face either sanctions, or there could be a much stronger blow up in the tensions in the Middle East, which would lead to supplies falling even further in terms of oil exports. So that energy transition to renewables has fast-tracked in 2023. South Africa, we've seen our own fast-tracking of the renewables, not because of any wars, or maybe it's an internal political war, but as Eskom has collapsed, we've all been forced to move to our own energy sources, mostly rooftop solar, and that has helped our own transition away from coal to renewables. And I'll also talk more about that when we get to South Africa and what's happening there. And then finally, the climate crisis continues to worsen. I don't think we should be calling it climate change, and I think we should be calling it climate change and volatility, because what we are seeing is a far more volatile climate. 2023 was the hottest year on record, but more importantly, we're seeing far more major impacts from very volatile climate events, whether it's floods or droughts or tsunamis. Those large-scale events are impacting global supply chains, either through ports being closed or droughts, and that's impacting commodity prices, both soft commodity, food commodities, and hard commodities, when it impacts ports and transport. And that has led to volatile commodity prices, and it's exacerbated both food and energy security. So things are certainly getting more volatile in the world because of geopolitical risks, because of climate change volatility, and so a lot of reasons to be very cautious. And together with a recession on the horizon, it's very understandable why people are cautious in their outlook. But I'll also talk to that when we get to our outlook slides. But before I get to South Africa, and before I get to our outlook, I'm going to hand over to our head of manager research, Kumlile Smith, who's going to share her insights. Thank you.
Good morning, everyone, and thank you very much, Carl, for having me as a guest in terms of your ECOS webinar. From a manager research insights perspective, there's actually so much to discuss over and above a manager research insights. It's also that time of the year where we can attest with conviction that silly season or holiday season is upon us, unlike the recession that we waited for from a US perspective that didn't arrive. In terms of some of the things that I will discuss from our insights perspective, I'll talk you through our manager insights, talk you through the elite performance that we saw from our exchange traded funds. But over and above that, please make sure that you get your hands on our stewardship report. That's also out, and I'll talk you through that in the next few slides. And if there are any parents on the webinar today, I think it's also that time of the year where everyone gets really proud and talks to report card performance of their children. And I'll also show you some of our top quartile, top student, A+ performance that has come through from our funds. But to kick into in terms of manager insights from a performance perspective, I think the most important thing, we have made some changes, especially to our multi-asset or balanced range, as well as our equity range of funds. And I think with anybody knows that change is not easy, change is quite uncomfortable, but it can equally be a rewarding. From an absolute perspective or from a multi-asset perspective, we've made changes to our Synergy or multi-asset range, where we added a boutique asset management firm in Visio, where we added the Visio balanced mandate. And this addition actually just brings some agility into the portfolio, considering that it is blended with the very large brand halo kind of firms. So we're actually quite happy and excited about that, and we continue to monitor that portfolio. How we funded that change came through from our large brand halo firms, managers like Allen Gray, as well as Coronation. And we made some changes to our absolute equity range, and that absolute equity range, where we added again a steady Eddie, a manager that's quite closely benchmark cognizant, and that's the MNG SA equity portfolio. Quite comfortable in view of the changes that are equally happening at MNG in terms of the succession planning and changes happening internally. But most importantly, we're comfortable with the fact that we're blending again here a large asset management firm with a number of boutique asset management firms. This is testament to how we view the world of managers. We believe that there's a room or there's a place for both, where we blend large brand halo firms with smaller, more nimble, more boutique asset management firm in order to reach our desired outcomes. Over and above that, there have been some changes also from an industry perspective or trends perspective, where if you actually just look at the chart on the right, you'll be able to see that there have been changes that's happening, where the shift or the dichotomy that's actually happened is that the pressure has moved away from fees more than anything, but more to concern to sustainable investing. And from a sustainable investing perspective, I think testament and true to form in our pioneering Sygnia ways, we don't just walk the walk, we talk the talk. You'll be able to see that in our stewardship insights, and you'll also be able to see that in our 1,200 ETF that's yielded a good investment performance of 14%. And I'll show you that in the next few slides. So we actually walk the talk the talk. But I think the most interesting thing more than anything is that the level of client interest has increased significantly into that sustainable investment space. And over and above that change has also been that fees have almost remained steady, while there has been a significant increase of 89% from a sustainability perspective. While on costs or changes, I think the other key thing that we continue to see, and again, testament to who we are as a multi-management as well as an asset management firm, is our key focus on costs. But interestingly enough, on the local side, as well as on the global side, we are seeing costs increase, but over and above costs increasing has been the increased consolidation or strategic partnerships or limited partnerships that we are seeing in both the local as well as the global space. From a global perspective, according to the PwC Asset Management Report, 73% of global asset management firms are actually considering strategic consolidations. And that's quite interesting, because on the local side, what we did see from a corporate activity perspective or merger and acquisition perspective has been 8 large BEE firms actually also equally consolidating. And again, one of the other key ones from a local side has been the strategic transaction or partnership that we saw come through from 10X as well as with CoreShares. I think one of the other interesting developments, which will lead us also to the next slide, is the performance that we have seen, or us actually launching our own Sygnia active FANG AI fund, and the performance there again has been quite interesting. While we're on that point also, in the same survey or in the same global asset management report that we did see come through from PwC, has been that 60% of global asset management firms are actually considering changing the existing UTs or mutual funds, as they're known in the offshore space, into active ETF strategies, and 20% are actually in the process of doing so. Oops. Just to take it back one slide. In terms of the elite exchange traded funds, I did allude to the fact that there have been some significant strides from a performance perspective. To tie this slide also back to what we saw from asset class performance, where Kyle touched on where the performance came through, especially on the offshore side, where we saw strong performance come through from European markets, as well as the US market. I think FANG has been one of the key outliers in terms of performance because those returns have just been phenomenal and predominantly driven by the Magnificent Seven. But over and above that has also been some changes that have happened within the exchange traded fund environment, where we have seen a number of ETFs kind of grow or surge in that perspective, with us also launching our active FANG AI ETF strategy. And that you can almost see that growth come through in the chart on the right again, where you can see that the bars are quite increasing, with the lower blue line showing you the year-on-year change from an AUM perspective. To bring it back in-house in terms of how our funds have performed, also keeping at the back of your mind the performance that you had seen come through from that European market, the US market, and the lackluster performance that Carl will talk through at the end of this session, from a South African perspective, has been actually looking at the Euro Stoxx 50 ETF fund actually gaining a significant return of 25% over the period ending October, and again capitalizing on Europe's unexpected economic resilience despite the energy crisis concerns that we did see. And also, if you look at from an EM perspective, or looking at emerging markets, you know that EM ETF 50 returning a return of 22% as at the end of October. And this has actually been quite interesting, considering that, you know, in the EM space, you know, China's considered the big stellar star performer, but we haven't seen really strong numbers come through from them, considering, you know, some of the conditions that they have seen from, you know, the lack of performance of China really never reopening to what we had anticipated. But over and above such anticipation has been the concerns that we do continuously see come from the property sector as well. And actually that fund, you know, returning a good investment return of 22%. On the Japanese side, more than anything, we saw good performance come through from the Japanese MSCI ETF range, returning a return of 18%. And again, you know, it's benefited from that expansionary monetary policy that we did see come through from the Japanese central banks. Also, you know, I think earnings environment has been quite favorable for them, and that weaker currency has actually benefited quite significantly from a performance perspective. I mean, we touched briefly in terms of, you know, the lackluster performance that we did see come through from China, but equally so holding its fort and holding performance and delivering a double-digit return of 18%, 17.3%, almost 18%, despite coming back from quite a low base we saw in the previous year, and the concerns that we do continuously see from a property sector perspective. Over and above that, again, is that last fund that I spoke to earlier in terms of that S&P 1200 ETF, where we strongly believe in the changes that do happen from a climate perspective, where we actively engage with managers as well as counters across the local as well as the global market. But equally so important for us is that this does not come at the cost of investment returns. On the next slide, I think I actually alluded to it. It's also that time of the year where most parents are going to see their little kids receive their awards and top performance come through. This is A-class performance, A-plus performance. I think it's almost a slide where you almost need to pause and take it in. And if you look at the performance, especially from a peer ranking perspective, with all the Sygnia funds across the CISA categories as of the 31st of October, just to kind of take it in, look at the performance on a 1, 3, and 5-year basis, and the since inception performance, record, stellar, top quartile, consistent performance that has come through. Again, I won't, you know, brag too much, even though we've got the bragging rights from a FANG AI perspective, with a return of 64%, again, propelled by the gains we continuously see towards artificial intelligence. And this is again across the spectrum from chip making, health innovation, generative AI, quite robust balance sheets that do come through from these artificially driven types of companies. But over and above that is one of my favorite funds. This is the second fund where you see the top quartile performance come through from the worldwide flexible fund. Stellar performance that does come through from there. Again, for me, this fund is one of my favorite funds, simply because it shows you the skill that is so available within our Sygnia investment team, where they continuously, on a day-to-day basis, actively trade the market. Those tactical asset allocation calls have actually boded so well for performance. And over and above that, the currency hedging that they are able to do has rewarded the portfolio quite significantly. And that 16.5% investment return, testament to the skill that we have in-house, testament to the portfolio managers who work on this fund on a day-to-day basis. So well done to the lads who continuously work on this, a 16.5% investment return. Similarly, On the skeleton balance side, I think, again, innately, as any multi-manager firm, the premise of our thinking, or the core of who we are, more than anything, is understanding where expected returns come from across the spectrum of asset classes, where we actually build our portfolios on a strategic asset allocation basis, as well as combine that tactical asset allocation skill that you saw within the flexible fund. And if you look at that skeleton balance 40 fund, also returning 9.2%, again, testament to the views from a strategic asset allocation, that tactical asset allocation perspective, more than anything, returning 9.2%, quite good investment returns coming through. One of the other darlings from a more conservative perspective is also the Sygnia Enhanced Income Fund, which has returned 9.8% over 1 year. And I think this is quite intricate in terms of, we had very low exposure from a bond perspective, but we had pristine instrument selection on the credit side, very minimal volatility, and actually benefiting a cumulative of 125 basis points. So it actually has bode quite well from how we have done that instrument selection, how the asset allocation has worked there. And again, I think in the last one is that skeleton absolute balance fund, where we did see a really good performance equally come through at 9.1%. In a world where we have, heard higher for longer, sticky inflation, that inflation-linked bond exposure, or those linkers that we had exposure to, actually held the fund in good stead and actually delivered a return of 9.1%. Just in terms of, just to kind of close off from an insights perspective, I urge you to please get your hands on our stewardship investment report. Our lead analyst in the ESG space, Nikita Hadskins, as well as the other members of the team, this was genuinely a labor of love, where they spent arduous hours compiling through the work, going through each and every vote where there has been abstentions, where there have been votes for or rejections, as well as dissensions, totaling a number of 7,922 votes. I think that's actually quite massive and quite impressive. Kudos goes to the team who also put the stewardship report together. Get your hands on a copy of the same. But more than anything, when I say we walk the walk, we talk the talk, and we equally believe what we do with conviction, is that there's active involvement from our side in terms of, innately being passive, but also being involved in that space where we look at corporate actions, we look at those ESG matters that are quite concerning from an environmental perspective, a social perspective, and a governance perspective. But over and above that, where we don't believe, as you will be able to see, for example, Sygnia is one of those where we had an issue with the remuneration perspective from an executive pay. From an executive pay perspective, we saw the subpar performance come through from Sygnia, so we actually held our conviction and rejected, that remuneration policy for the execs there. And over and above that has been quite topical from a transaction capital perspective on the listed equity market, on the credit space. We have seen some impairments in terms of assets, and we actually have been continuously engaging and continuously monitoring. Sasol, for example, yes, we rejected them from a climate perspective. And this is not just because we don't like Sasol, but it's important to ensure that there's adherence from a science target perspective. As we know, and Carl touched to it from a climate crisis perspective, it's not just, a climate, your climate concerns from it being almost the hottest period, but it's trying to align to that 1.5 degree Paris alignment agreement that we need to see, and ensuring that there's adherence from a scope 1, scope 2, and scope 3 emissions perspective, to ensure that we do reach that 1.5% by 2030. So trying to have some alignment. And again, our stance from this is not just to decide that we're not going to, to take part. South Africa has followed a just transition approach, but more than following a transition approach is to trying to ensure that we do engage from a sustainability perspective, and also taking into consideration those environmental and social governance concerns. Where we have voted in favor, or where we have been quite happy, is we voted for South 32's climate report. We actually they committed to that net zero operational green gas target. It is almost, a moving target in terms of trying to get to where we need to get to. But over and above that, we make sure that we are actively engaged. We engage with these managers, and this happens on both, an active asset management perspective, as well as trying to get involved with the relative counters. I'm going to hand over to Carl to talk you back to South Africa, so that he can kind of give you an outlook in terms of where we're going from a 2022 perspective. Thank you, Carl, for having me as a guest today.
Thank you, Pumi. That was fantastic. So moving on to South Africa before we get to our outlook. And looking back at South Africa 2023, well, we're a year in from load shedding. There were many, many promises that in November last year, that by November this year, that load shedding would be gone, or at least down to stage 1, but we're still in stage 6. So some things change and some things stay the same. The things that have changed, unfortunately, have changed for the worse. And we've seen Transnet that has basically collapsed this year, and South Africa's finances have also looking very, very dire. We have our South African finance minister saying our public finances are significantly weaker, and that is spot on. They are not looking good. Treasury did issue Transnet a 47 billion rand guarantee, but they didn't provide an equity injection. So it is good news, at least in terms of what is being rolled out to SOEs in terms of bailing them out. No cash payments, just guarantees. But Treasury literally can't afford to bail out any more SOEs. If you look at high interest rates, we look at our skyrocketing debt levels in South Africa, you combine high interest rates on high debt levels, and the amount of money that we're paying in our budget each year to interest payments is dwarfing everything else. In South Africa, getting very, very close to a debt spiral where we unfortunately get trapped, spending all our money paying down debt and leaving very little to invest in growth initiatives that we so desperately need to create jobs and to move forward. So let's look at some of the highlights for 2023 in South Africa, and also some of the key questions for 2024, pivotal year, particularly with elections. But while we're on Transnet, Transnet and Eskom were the two SOEs that stole the limelight in 2023, not from a good news perspective, unfortunately. The good news is that National Treasury has put in clear milestones for both Eskom and Transnet in terms of their bailouts. And hopefully with that more strict oversight, we will start to see some improvements come out of those two utilities. What is more concerning, though, is the chart on the right, which is from the South African Institution of Civil Engineering. And it shows the dwindling number of civil engineering practitioners in local government. So the blue line is the number of engineers per age. So the graph on the left is 2005, starting at the bottom with the 25-year-olds up to 63-year-olds. You can see a nice spread of engineers across all age groups. Then fast forward to 10 years later to 2015, still quite a few engineers, but not as many as 2005. And then you go 5 years later to 2020, and if you can spot the engineer, you're doing better than I am. So a very, very worrying concern that, yes, National Treasury has put in these great hurdles that need to be met before bailouts happen for Transnet and Eskom, but can South Africa in general move forward without the critical skills that are needed, in particular, in this case, engineers. Now, I don't know if the dwindling number of engineers is linked to the policy of cadre deployment, but it is very, very concerning that the Zondo report found that the ANC policy of cadre deployment violates the Constitution in 5 different ways. 5 different ways that the Constitution is violated by this policy, and yet it is still in place. And very, very concerning the fact that that is still enforced. Very, very concerning that the number of skilled engineers in local government is close to zero. It does give us cause for concern as to whether South Africa is able to improve its growth outlook in 2024. We desperately need growth to improve, to be able to employ more people, to improve everybody's living standards. But the forecast growth for 2024 in South Africa, consensus Bloomberg estimate is 1.3%. That's for an emerging market, that's abysmal. And that's why we remain underweight South African equities. We believe it is too early to get excited about South African equities. Even though one of the huge hurdles that has impacted South African equities has been load shedding, and we are getting to a point where many companies are self-sufficient. I still think that that's still too early. Maybe 2025 or late 2024 is a story for SA equities, but a lot of concerns. And one of the big risks, obviously, is elections next year. We have the elections in April, May next year. And the big question is, what will the ANC support turn out to be? Will they get over 50%? Will they get just under 50% and have to do a coalition with a small party? Will they get close to 40% and have to do a coalition with the EFF, which could see some far more extreme policies put in place? Will it be below 40%? It's very hard to tell. The polls are all over the place. Some saying 48%, some saying 41%. So we'll have to see, but that remains a big risk for us. And then obviously any policies that get rushed into being ahead of the elections to try and buy votes. We're seeing that the two-part system has been fast-tracked to early 2024. Yesterday, that was announced, fortunately, that we have a 6-month breathing room, and that's been pushed back to September 2024. But it's still going to be a very tight deadline in terms of the systems that need to be put in place, and the likelihood that most people are going to withdraw the 25,000 odd rand out of their pension immediately and spend that. And while that's good for growth and for spending in the short term, it is not good for South Africa's savings rates, which are also very, very, very low and not nearly as high as they need to be. We've also seen NHI that's been signed off, and despite everyone objecting to that. So we'll be watching that closely. But again, ahead of elections, anything can happen and probably will happen. So a lot of volatility expected over the rest of this year. And South African bonds, we look incredibly attractive relative to global bonds around the world. They have had a very good run in the month of November, along with all other emerging market bonds, stellar performance. So not looking as juicy, I would say probably closer to fair price. We have cut our SA bond exposure. We still have South African bonds, but we're not overweight. We're neutral South African bonds. And we think that the risk versus the reward is now fair in that place. We also saw the SARB and keep interest rates flat, and that is fantastic news. At least it's not putting any more additional pressure on the consumer in South Africa. And hopefully with petrol prices coming down this month, tomorrow in fact, so don't fill up your tanks today, wait till tomorrow. With interest rates flat and petrol prices coming down, a little bit of relief for consumers. But being back at stage 6 puts that pressure back on. It's not just consumers, but it's all the retailers who have to run their generators, and that's just an additional tax on everybody. And you know, very, very sad to see that still happening a year into the crisis that we are facing. Okay, so something different, something fun, something interactive. We're going to do a poll. So very shortly, there should be a poll popping up onto your screen. I will read through the questions, guide you through them as you answer them. Please do participate. And I'll also be talking through the charts that are showing on the screen, which link to some of those questions. So let's look at the first question, which is, where do you see the rand dollar in a year's time? 18 to 90, roughly where it is now. 17 to 18, below 17 if you're bullish, 19 to 20 or above 20. One of the things that could be driving this is the dollar. A weaker dollar will certainly help a stronger rand. And if you look at that middle chart there, interest rate differentials, but that's against developed markets. Interest rate developed markets of the dollar versus the euro and the yen point to a slightly weaker dollar in 2024. And similarly, if you look at the bottom panel in that middle chart, if you look at momentum within the dollar, that's also looking like it's rolling over and weakening. So compared to developed markets, the dollar could be in for a slightly weaker year in 2024. Of course, the main driver for the dollar is rest of world growth. So we really need Europe, Japan, emerging markets, China to bounce back in terms of their growth for the dollar to weaken. And that is, I'm not quite sure that is going to happen. And I'll talk more about that in our outlook, but be very interested to see what your views are in the currency. Point two, will the US go into recession in 2024? That is the big one. You saw from our earlier slide from JP Morgan that the consensus certainly is that the US will go into recession in 2024, mostly towards the end of 2024. But interesting to see what you think about that. Then the big one, question three, which asset class will deliver the best returns in 2024? Global equities. Now, global equities are dominated by US equities. And if you look at the right-hand chart there, there's a very good correlation, although it's a long-term correlation. So this doesn't predict one-year returns, this predicts 10-year returns. But if you look at the 10-year cyclically adjusted PE of equities, and you look at the forecast 10-year return, there's a very strong correlation. And based on where the current 10-year cyclically adjusted PE is in the US is likely to give you a paltry 4% dollar return over the next decade. Again, doesn't mean that's what you're going to see next year, but certainly over the next decade, US returns are going to be much lower than they have been in the past. Also looking to the left-handmost chart, which shows central bank purchases. That's all central banks. But you can see there how central banks were net sellers of gold from the 1970s down to the 2010, and how that's reversed over the last 10 years, and how central banks have been buying gold. Now, the interesting thing is that the purchases have been dominated by emerging markets, China, Russia in particular, as they try and diversify away from dollar assets or assets that can be frozen. They don't want their assets frozen, so they are moving away, and that has definitely helped the gold price. So on a fundamental perspective, as you know, I'm not a big fan of gold. It's just way too stretched from a cost perspective, way too stretched relative to other precious metals like platinum and palladium and silver. But that said, when you've got strong emerging market buying, that gold could go even higher. Gold's close to, in fact, I think it just did briefly reach its all-time high, and that may continue on the back of geopolitical risk and central bank purchases, even though it is very, very stretched from a fundamental perspective. Again, fundamentals talk to long-term view, but over 2024, things can stretch even further from the fundamentals, and gold could be driven further from its fair value by either increased geopolitical risks or accelerated EM central bank purchases. Question four, what is the biggest risk to the investment portfolios in 2024? The first point is it South Africa? Do we see a South African implosion? We've got our elections. That could be a key risk. We've got our budget in February. It could be a key risk. We've got very low growth rates. Will that lead to rand weakness? And as a result, South African asset class returns remain the lowest returns in 2024, like they were in 2023, either just because of low growth or because of rand weakness. Second possible risk is climate change. We've seen a lot of volatility, hottest day on record in 2023. Is that a risk to our portfolios? Could we see commodity prices impacted because of some extreme climate change events? Point three, weak commodity prices. This is very much driven by China. China has recovered. They have stabilized in terms of the growth perspective, but they've done an L-shaped recovery. They've fallen. They didn't crash, but they're moving sideways at around about their 5% growth targets that they were predicting. But the property market remains a headwind in China, and although they are trying to do things to reverse that, we haven't seen any significant indicators that the property market has bottomed, or at least that it's turning around. And while the Chinese property market remains weak, commodity prices are likely to remain weak as well. So could we see commodity prices derail emerging market portfolios, derail European portfolios, Japan, Chinese portfolios, everything that is linked to global trade? Will those be weak because of a weak China? Risk four, which is kind of link to one of the earlier questions about recession. Will we see a recession or just a soft landing as a result of higher for longer interest rates, higher for longer inflation, which leads to slow growth? And could that lead to markets pulling back in 2024? Not necessarily a recession, but that's also one of the risks with 0.4 or 4.4. And then finally, cyber risk. AI has led to some interesting productivity gains. It could lead to potentially fantastic productivity gains, but it could also lead to some big cybersecurity or fraud risks. Could we see another major event derail either or cause a banking crisis or crypto crisis as a result of crypto-related risks, including fraud? And then final question, question 5 for all, while we're talking about AI, have you used ChatGPT or Google Bard or any other large language model, and has it improved your productivity? Yes or no? We're very interested to see how many of you have actually used that in your day-to-day lives and whether it has helped you in your day-to-day lives. Okay, so that is the poll. Let's move on to our outlook. Okay, so 2024, key question: what are we going to expect? What are the markets going to do? So our base case scenario is that high interest rates persist, but inflation falls probably a little bit faster than expected. Growth also falls, but not into recession. And the falling of inflation allows the Fed to stop hiking and probably to start cutting in the second half of this year. But we don't have, although growth is falling, it doesn't fall into recession. And we have not quite Goldilocks. I'm definitely not a Goldilocks believer, but certainly we have a slowdown. And we might have equities falling in the second half of next year, but we avoid a recession. So what are some of the reasons that we believe this? Well, why will inflation fall? Firstly, inflation is likely to fall because supply bottlenecks due to COVID are finally done. COVID has been distorting markets for the last 3 years in phenomenal ways. Manufacturing versus services, lockdowns versus mobility, inflation because of supply bottlenecks, inflation because of this huge move back into services. Everything was pretty much all over the place. That is finally now out of the base. And you can see there, the chart on the right showing that supply bottlenecks no longer impact inflation. And the huge and rapid fall we've seen in inflation has been that decline. Inflation is still likely to fall going forward, but that's as growth slows because of high interest rates. So we've got supply bottlenecks out of the way. We've got growth slowing slightly because of high interest rates. Our third point for why inflation will fall because China is still exporting deflation. And the fourth reason is not so much about inflation, but it's about the Fed's reaction to inflation. And we had a massive spike in productivity in Q3 in the US. Labor productivity spiked 4.7%, which is great because productivity has been very, very, very low in the US for quite some time. Was it caused by AI and the rise in AI? We're not sure. It's just one quarter. Will AI lead to improved productivity going forward? That's also a big question, and that could impact the outlook to markets definitely to the upside. But regardless, right now we've seen that inflation, if you look at net labor costs, so wage inflation less productivity, we're below 2%, which is the Fed's target. So productivity rise has taken pressure off the Fed and allowing the Fed to at least not have to raise rates or maybe even cut rates sooner than expected. Likewise, if you look at US inflation less rental inflation, that is also below 2%. So the only thing holding up core inflation is rents, and that is predicted to fall quite rapidly this year. So things definitely looking on the right side when it comes to inflation, likely to continue to fall. Yes, we're still in the higher for longer camp, but we think that we could see interest rate cuts starting to come through in the second half of this year. Markets already have priced a lot of that in. The 10% bounce in November across bonds and equities, EM, was very much about that improvement in the inflation outlook. That said, there's still a lot of risks. And inflation is not going to fall in a straight line. In fact, we had Fed Chair Jeremy Powell say in the November meeting that inflation has given us a few head fakes. If it becomes appropriate to tighten policy further, we will not hesitate to do so. So while our base case is for inflation to fall, it's not going to do it in a straight line. And we do think volatility is going to remain high, not only because of inflation, because of geopolitical risks, and that's why we are remaining nimble. And our overall outlook is neutral. And we will use volatility to either take that overweight or use that volatility to go underweight. But we are focusing mostly on a volatile outlook and being nimble around that. So inflation likely to fall, which is just generally good. Growth is going to slow. That is without doubt. How much it slows is what everyone is forecasting. Is the US going to slow into recession, or is it not going to slow into recession? Well, that is the big key. Why is it going to slow? Well, it's going to slow because of the lagged impact of high interest rates. Mortgage rates in the US are off their peak of 8%, which was incredibly high, down to the mid sevens, but that's still very high relative to history. And we definitely are going to see a slowing in US growth. But we do have some reasons to believe that is not going to lead to recession. One, well, why a year ago were we more bullish than consensus? Well, because the US consumers' wealth was far in excess of its normal range. The US did spend a lot of that in 2023, and that's why we went underweight. But it turns out that the US consumers' wealth, in terms of their cash balances, has been revised higher. But not only that, because markets have run so strongly in 2023, US consumers' wealth has had a record increase. So US consumers are feeling not only cash flush, but they're feeling very wealthy, which means that despite high interest rates, they're not going to cut back their spending. More importantly, employment hasn't started to run away, or unemployment hasn't started to run away yet. And there is some strong indications that with this gig economy and people working from home and people happy to work only a couple of hours a day from home or only 2 days a week from home because it's so much easier, that we could have a lot more flexible workforce, which could, again, increase productivity and keep not only number of people employed, even if they're employed for fewer hours, but keep margins relatively stable and thus protect earnings for companies. So a lot of reasons that while growth will slow, it won't slow dramatically. We also are seeing in the short term a rebound manufacturing. I've mentioned this in the last 2 webinars, that we are seeing green shoots of the manufacturing recovering. It's nothing fantastic. It's just bordering around recession, but it is definitely rebounding. Over the last month, we saw the Baltic Dry Index up 60%. Which shows that global trade is definitely recovering. That's very interesting to see. And iron ore is up 50% in the second half of this year, which is quite surprising because iron ore is predominantly used for steel, and it's predominantly used for China, and with the Chinese property market slumping, it's quite surprising to see iron ore up so strongly, and that will certainly help commodity prices in general and resource prices as well in South Africa. So given that view that inflation is likely to fall and growth is going to fall but not go into recession, we are sitting in benchmark. It's a bit of a cop out, sorry to admit that, but we're sitting neutral equity, neutral global bonds, and looking for volatility to get a good entry point. When it comes to making calls, good entry points make and break the investment. I mean, if you look at strategists, and the ability to forecast market returns, there really is no magic answer. There's no crystal ball. There's no AI with the right answers, and most strategists are right 60% of the time. And that's if they are incredibly good. So it's key to make sure that if you do make short-term decisions, that you do so in a very cost-effective manner, that you do so in a tax-efficient manner, that you do so with a very good entry point, so that you can, if you are wrong, unwind it, and you unwind it very quickly. So we remain nimble, and we remain very vigilant about what's going to happen in terms of the market outlook for this year. Then let's look at the risks for 2024, because there are a lot of risks that will create this volatility. Firstly, risk of recession. Yes, there is a risk that the very high mortgage rates in the US could push the US into recession. And we've got some strategists like BCA forecasting nearly a 20% fall in US equity markets because of a US recession, and that's quite drastic. Then we've got geopolitical tensions. That's Russia and Ukraine is still ongoing. The Middle East is still ongoing. While this is really a smaller probability, but there is a risk that either of those two could escalate, pushing up energy prices, which will push up inflation and cause central banks to have to hike rates just as growth is slowing and push the world into recession, not because of slow growth, but because of a high inflation. And that'll be a worst case scenario. Again, markets could easily fall 20%. Then we've got lots of political changes. In the US, there are elections. Right now, Biden's approval rating relative to Trump is dwindling. He is now below Trump in the polls. And even more importantly, the Democrats have fallen significantly in the polls relative to Republicans. So we could see a big change happening next year with Trump coming in, and that could have all sorts of implications. So we are going to be watching that very, very closely. South Africa, we've got our own elections early next year, around the second quarter. We need to be watching that. That certainly is a risk. Taiwan is a big one that's coming up soon, the 13th of January. We did see at one point that the two major opposition parties were going to combine, and then it was looking good that they would actually win the elections on the 13th of January, and they're pro-China, which would have reduced tensions between Taiwan and China significantly and possibly led to a big rally in Taiwanese equities, possibly Chinese equities. But in the last week, those two parties have decided to go their own ways, and the incumbent party is likely to stay in place, which means that tensions with China are going to remain. But we'll watch that very closely and see what happens. Extreme weather events, volatility, technological risks, and AI, again, more volatility. So on the first point, when I'm talking about risk of recession, there's a BCA survey, and I showed you earlier on the JP Morgan survey, which said 65% probability of recession next year. The BCA survey, they had 75% of the respondents believe that a recession is going to happen next year due to lagged interest rates. So certainly, while our base case is for a soft landing in 2024, the market seems to be expecting a recession in 2024, and if you're expecting a recession, well, then you should be underweight equities, not neutral equities. So that is something that is worth watching to see exactly what happens. Okay, so that's the Sygnia view, and let's have a look at what you said. So let's have a look at the poll results. Okay, fantastic. So where do you see the Rand dollar at the end of 2024? Most respondents, 32% saying 19 to 20, so slightly weaker Rand than we are now. Next on that was 18 to 90, and that was 25%, so roughly where we are now. 21% saying slightly stronger, 17 to 18 Rand, and then a small allocation with very strong and very weak. So quite a flat distribution of returns. And I must say, it is very hard to forecast the Rand next year. If China does do bazooka stimulus, commodity prices will rally, the Rand will rally, rest of world growth will be strong, dollar will weaken, and then you want to be long China, you want to be long South Africa, emerging markets, Japan, Europe, and short the dollar. Those will all do very, very, very well. But our base case is not for a Chinese bazooka stimulus. Our base case is that China carries on plodding along, in which case an inflation to slow but not to go into recession, and in that case you want to probably be overweight the US, and we remain overweight the US, and we remain overweight US equities. Again, if your base case scenario is bonds, if your base case scenario is recession, then you want to be overweight US bonds. If your base case scenario like ours is soft landing, you want to be overweight US equities. If your base case scenario is Chinese bazooka stimulus, then you want to overweight the rand and emerging markets. But given our base case scenario, we are in the 18 to 19 camp, roughly flat SA currency movements, but with lots of volatility, and we will continue to use that volatility. Will the US go into recession? Oh, interesting. So 2/3 of you believe that the US will not go into recession. That's very interesting compared to JP Morgan, which was 2/3 said there would be a recession, and BCA, which said 3/4 would be a recession. And BCA last month, a month ago, was 90%. So that has come down, but still very, very high. So most of you thinking that the US will, similar to Sygnia's view, the US will not go into recession, in which case you should all be overweight US equities instead of US bonds or global bonds. And then that ties up with your expected best case returns. Which asset class will deliver the best returns in 2024? 2/3 of you say global equities, MSCI World, which is dominated by US equities, and then very small allocations to the other 4 asset classes. So that at least all ties up. So your expected return forecasts are consistent, and your RAND forecast is consistent with your economic views, which is great. What is the biggest risk to investment portfolios in 2024? So 2 answers roughly equally split. Half you say implosion in South Africa, and the other half you say high for longer interest rates. High for longer interest rates and inflation is certainly consistent with a slowdown in the world, and SA implosion is certainly consistent with a slightly weaker rand. And then finally, has ChatGPT or Google Bard improved your productivity? 71% of you say no. So I don't know if that's a specifically South African phenomenon or if that's a global one, but despite the huge euphoria about AI this year and the FANG stocks and the big drive in Nvidia's share price, their revenue has doubled third quarter this year to third quarter a year ago, all on the back of increased spend on servers and cloud computing because of increased need for spending, because everyone's going to be using AI for improved productivity using it in marketing, using it to help straight through processing, helping through process improvements. 2/3 of you say, 71% of you say no, it hasn't helped. So that is very interesting. So maybe it's early days when it comes to the AI revolution and productivity, or maybe it's a South African issue, but definitely it looks like most of you have not used AI yet to change your lives in any significant way. So that's a wrap for our poll and for our outlook and for our review on 2023. Thank you so much for participating in the polls. I really appreciate it. It's great to see what you are thinking and be able to share what you're thinking. But let's move on to the Q&A. Okay. Just some quick questions. Yes, the opening slide was in RAND terms. Sorry, when I was showing the return for the different asset classes, that was RANDs. So it included the weakness of the rand in those returns. Yes, this webinar, like all our webinars, will be available on the Sygnia YouTube website. So please, if you want to see a recording of this and you want to have a look at the slides, you can go to our YouTube channel, and the recording will be available there. Okay. A great question from Serena. She says, there was a mention of Sygnia operating out of Europe as well as out of South Africa. Where is that? You mentioned previously no longer doing Irish domiciled direct currency-based funds. Is there any intention to go back to global funds? Serena, good question. Yes. So we did launch a range of our funds. We launched the Fourth Industrial Revolution Fund. We launched our Healthcare Innovation Fund. We launched our income fund, a dollar income fund, all in dollar terms. So they were hard currency-based funds for your offshore money, not for local money. So you had to take them, you had to externalize your money first, and you could invest in those funds. We unfortunately closed them, and that was because the cost of running those usage funds from a client's perspective, just it wasn't worth it. And we're all about net returns. We're all about getting the best after cost returns for our clients, and it just wasn't feasible. We are, however, looking to get back into that. We're going to use a different vehicle. We're going to use an endowment vehicle, which still has very good compliance. But most of that we can do in-house, and we can keep the costs low through vertical integration, and we can provide you with dollar-based foreign domiciled investments in a tax-efficient way, in a cost-efficient way. And so we will be launching those funds at the same time that we launch our multi-currency platform. And so as you're all aware, we are launching next year our new Sygnia Online, our new platform. Can't give you the exact date. It's a trade secret. But when we launch that, a couple of months after launch, there will be a second rollout with our multi-currency platform, which means that on our platform, you'll be able to switch investments from rand-based products into the equivalent dollar-based products, and we will help you with the FX and help you through that process. But unfortunately, nothing right yet. We're waiting to get that platform in place so that there's a seamless operational process for you, and then we'll be opening up our offshore funds in a much more tax efficient manner, in a much more cost efficient manner. Thank you. Daniel. Daniel asks, with the acceleration, and then it's a good question, Daniel, with the acceleration of renewable energy transition, why do you think sustainable and renewable energy stocks have done so badly this year? High interest rates as companies are most small cap. Daniel, you are spot on. That is the exact answer. So, if you look at Fourth Industrial Revolution Fund, the number of companies there, in fact, roughly half of those companies are particularly focused on renewable energy and other types of fighting climate change and improving new techniques to fight climate change. But because it's new products, because there are new companies, they are obviously small. And they obviously have high levels of debt and low levels of profitability. If you do a graph and track the performance of the Fourth Industrial Revolution Fund and the Russell 2000, which is US small caps, they are almost identical. So the Fourth Industrial Revolution Fund and renewable funds haven't been given any benefit for the fact that they are focused on growth segments, that they're focused on products that are likely going to do very well over the next 5 years. They've been completely overwhelmed by the devastation of small caps. Now, while the S&P 500 and NASDAQ are back to all-time highs, the Russell 2000 US small caps is still 24% below its all-time high. And that just shows how the impact of high interest rates have held back small caps and non-profitable companies, and that's had a detrimental impact on renewable companies and Fourth Industrial Revolution. Now, that will bounce back at some point when the Fed cuts, but it all depends on how quickly the Fed's going to cut, and that is something that we're not quite sure. So there's definitely something we're watching very closely, but but we don't know exactly how quickly the Fed is going to cut in the second half. If assuming our base case that we stay in this higher for longer environment where there's no recession, there's a soft landing, if the Fed cuts, but they only cut a little bit, well, then small caps could remain under pressure. But we'll have to see how that rolls out in 2024. Okay. Altus points out that yes, there are definitely tax benefits to investing in retirement annuities or pension funds or retirement funds, but he's worried about the risk of prescribed assets. And the question is to what extent we are predicting prescribed assets to happen this year or in the short term, and whether that means people shouldn't rather take on the tax burden of investing directly offshore or in the Sygnia global ETFs or global balanced funds as an alternative. It's a very good question. Certainly, our base case is that there aren't prescribed assets anytime soon. Yes, there are concerns about South Africa being caught in a debt spiral, and if we get to the point where South Africa can't actually issue more debt, then they may be forced to do that. But what we've also seen at the same time is that foreign holders of South African bonds have gone from mid-40s. At one point, there were nearly half of foreigners held half of South African bonds. It's fallen down to 20%. And we've seen how quickly South African bonds have rallied in the last month as a result of falling US interest rates and people trying to get into emerging market bonds. So right now, there seems to still be an appetite for EM bonds, including South Africa. I think more importantly, that the National Treasury are being very clever with where they're sourcing debt. They're looking at lots of different ways to source debt, not only dollar-denominated debt, but short-term debts, effectively T-bills, JIBAR-linked debt. They recently launched the Sukuks. So they are being very clever with how they're trying to fund the shortfall that we're seeing. And the National Treasury is definitely one of the most amazingly well-functioning parts of the government, and so I don't see the need for prescribed assets. Certainly in the short to medium term. Yes, anything can happen, but I don't think there's a need for it just yet. I think the fact that they chose to move to focusing on the amount of holdings in retirement funds that are invested in infrastructure assets, I think that's important. And we may see increased focus when it comes to reporting to trustees on how much pension fund is holding in South African bonds and how much a pension fund is holding in infrastructure. But even though we've moved to a neutral level on South African bonds are still amongst the highest yielding asset classes in the world. So while they have their juicy returns, there's no need to force anyone to buy South African bonds. If we get to a point where South African bonds are looking unattractive, we may get to that point, but if we get to a point where they're looking unattractive, it's because they've run hard and rallied hard, and they probably wouldn't have rallied hard unless we've sorted out our debt issues or we put reforms in place, and then it becomes a moot point. So for now, it is a risk, but we think it's a minor risk. And we still prefer going into retirement savings, and particularly because the new two-pot system means that you can withdraw up to a third, your one-third pot going forward. Obviously, it's only that one-third pot accumulates only going forward, but you can pull that out on an annual basis. So it does reduce your liquidity risks. And Dile asked a question which seems like a question he should have asked yesterday at our results presentation. He says, given how challenging the year was for asset managers, what attribute to Sygnia's AUM growth? And Dile, at the moment, our biggest client is the market. And a lot of Sygnia's funds are offshore funds. All our ETFs, or not all, but predominantly our ETFs are offshore. Within our balanced funds, we've got close to 40% offshore. So when the rand weakens, our AUM weakens, and we definitely have a bias towards offshore investing. And it's one of the reasons why, unfortunately, we've had to cap the discretionary investments on a unit trust, because our clients have a great preference for our health innovation fund and our global balanced funds, our global flexible funds, health innovation, fourth industrial revolution, FANG, and those strong inflows have unfortunately capped. At the same time, it means that we've got a very strongly offshore-based client base, and so when the rand weakens, our AUM does weaken, and so does improve as well. Mervyn asks for the 1-year performance of the skeleton balance 70 versus 40. I can't give that to you offhand, sorry. The fact sheets are there on the website if you want to have a look. But just because I always love plugging the Skeleton Balance 70 fund as my favorite fund, I hope you saw my post on LinkedIn. If you didn't, please follow me or connect with me on LinkedIn. I'm posting some interesting economic updates, but also we saw the 10-year anniversary of the Skeleton Balance 70 fund. Phenomenal performance across all time periods. At a very low cost of 35 basis points. The Skeleton Balance 40, that only turns 10 next year, so it's slightly younger, but it's also at a great fee of 35 basis points, and also phenomenal peer relative performance in its category, a CISA category, and a great fund for the more conservative investor. Sean asked how much of the global returns have come from rand depreciation of global ETFs. Sean, if I scroll back, excuse me 1 second, to that first slide, I'll share it for you. Just so everyone can have another look. You can see there that these are all rand returns, but US cash is basically the weakness in the rand dollar. So you can see that the rand weakened 9.4%. So if you want the dollar returns, you need to subtract 9%. So therefore, US equities did 3.33% on this chart. You subtract 9% in terms of the rand weakness, that gives you a roughly S&P 500 return of 24% or so. So I hope that helps in terms of understanding the impact of the rand on these returns. Obviously, the SA bonds, SA cash, SA equities are already in rand, so you can't subtract that 9.4% from that. The global bonds, interesting, you can see they're roughly flat in dollar terms. Global property, roughly flat in dollar terms. So yes, some asset classes not looking as good. I did mention there that those asset classes linked to high interest rates struggled in 2023, and they're likely to do better in 2024. So we may see a switch out of the best performing funds into funds that were hurt by high interest rates as interest rates roll over. But instead, we've seen a big bounce in November, and even though we are predicting a cut, we'll have to see how quickly US interest rates are cut next year to know exactly how much that rebound will be. Yes, Adam, SA cash beats SA bonds over the last year. You're spot on. Clive says, is Sygnia bullish on EU and Asian equities for 2024? Clive, I desperately want to be bullish on those two asset classes because they're showing so much value, but that's not our base case. Our base case is that in a slowing environment, we're not going to see a risk on to the extent that China, resources, commodities, Japan, Europe, all bounce more strongly than the US. In a slowing environment, like we're forecasting, the US is still going to be the most defensive place. They've got the best return on equity. They've got the best, most defensive market because it's mostly services driven, not manufacturing driven, and most defensive companies with very strong moats. So, when you're fighting over market share, it's likely that the US will do well. You really need a strong US, sorry, you really need a strong risk on environment to go into the higher beta investment. So we remain overweight US in our regional look. Sean says, would the recession not be a correction for the inflated AI rally? Certainly, Sean, that is a risk that the Magnificent Seven pull back from their huge runs, and that causes not a recession, but causes markets to not have as good a return. And that again talks to that switch out of quality markets. Again, there's a great chart I posted on LinkedIn showing how well quality has done over the last year or year to date, and how poorly size has done. So small caps have been decimated by high interest rates, and quality companies, which is predominantly the FANG stocks, because they've got such strong balance sheets and have such great interest income, how they've dominated 2023. 2024, we are only going to see cuts in the second half of the year. We're probably still going to have relatively high interest rates by the end of the year. So there's still going to be a tough, it's still going to benefit those quality companies more than size. So again, it's like EU and Asia. I want to be long small caps because there's so much value there, and there might be a very rapid snapback in that performance. But it's just still not our base case scenario. Things are still, because we're avoiding a recession, because there's no clean out, because we're kind of muddling through that, and interest rates are going to stay higher than neutral. Growth is going to stay quite low. I don't think we're going to see a big bounce back in those stocks. Shahid asks, are there any thoughts on the Bitcoin rally to 42,000 all-time? Well, it's not an all-time high, but it's definitely a high year to date. Is there decoupling taking place from other asset classes? Certainly, I mean, gold has rallied also to gold actually is at an all-time high, but Bitcoin's rallied a lot more than gold. And I think a lot of the Bitcoin rally is based on the expectations of the US spot ETF launch. There will be a spot ETF that will be launched. I don't know when, but I think there's a lot of buying the rumor, and when it actually gets to launch, we'll see how much money flows into that ETF, and there may be a bit of a selling effect. But I don't know what's going to happen there. You've got again some very wide views. BCA bank credit analysts, they believe that Bitcoin's going back down to $5,000. But then you also have Alpine Macro, our other strategists, who think that Bitcoin's going to $100,000. So it's definitely one that has very, very, very wide outlooks. Mark, I hope I've answered your question on the tech outlook for 2024. Yes, I mean, in general, I think that there has to be an improvement in productivity from AI, and that will definitely help keep wage or unit labor costs in line, which should help both from an inflation perspective and a margin perspective. But how quickly that happens is something that we don't know. Will it happen in 2024? Was it the cause of the Q3 spike in 2023? It's hard to tell. Productivity is one of those things that are very, very difficult to measure, and even more difficult to give causality to, correlation possibly. Good question. Do you see South African interest rates being cut in the first quarter of 2024? Unlikely. I think South African interest rates are going to be cut around the same time as US interest rates. So it's probably in the middle of the year, maybe slightly towards maybe August. Right now, the markets are pricing in a June cut, but it might move out to July or August. It all depends on what happens in terms of each data point. that comes out on inflation. Drew says, what are our views on the Fourth Industrial Revolution Fund? Fourth Industrial Revolution Fund is a fantastic fund. And the underlying stocks really are strategic holdings. They've got, they are companies that are bringing new products to market that will gain market share. And in a low growth world, you want to have exposure, and especially growth does particularly well. And you've seen that we've sold or reduced our value exposure. In a low growth world, growth does very well, and Fourth Hour does have those growth stocks, but it's being held back by the fact that interest rates remain high. So it's a bit of a mixed outlook. Wayne says, what is the case to remain in cash with the threat of US stocks going into recession? Wayne, if you think US is going into recession, you want to be long US bonds. It's in a simplistic way, we like to look at it this way. If you think that China's going to do bazooka stimulus, you want to be long Japan, Europe, emerging market equities. But we give that 5 to 10% probability. If you think that there's a geopolitical risk and it's going to cause inflation to spike, which will force central banks to push up rates and push us into a recession, then you want to be long US cash because bonds will sell off massively as a result of interest rates having to go up. But we also give that maybe 10 to 15% probability. The third case is the US goes into recession, and that is when you want to be long US bonds or developed market bonds, because as that growth expectations plummet, bond yields will come off. Maybe that's a 20% probability. And then our base case, which is 60 to 70% probability, that is a soft landing in the US. Growth slows, but it doesn't go into, well, growth is slow, but it doesn't actually go into recession. And then you want to be long US equities. So that's our probability matrix for our outlook and why we remain overweight US equities. Peter asks, do you think skeleton 70 will catch up to skeleton 40? Certainly over the long term, skeleton 70 at this high allocation to equities will perform better than skeleton 40. In the short term, it all depends on volatility and your measuring point. Pierre asks, when do you expect global funds to reopen? That's a great question, Pierre. I hope as soon as possible. It all depends on flows. If we start to get flows into our new funds, and so to our domestically focused funds, then that will help that. So let me do some quick marketing. Thank you, Pierre, for reminding me. How many people have we still got on the call? Quite a few. We will be launching a campaign shortly with our transnational fund. So as you know, we converted our SWIX unit trust to the transnational unit trust, South African equities, listed on the JSE, so that they don't qualify as global, but we're investing in those stocks that have global revenue. So we're investing in the Richemonts, British American Tobaccos, Glencores, Anglo Americans, and that fund has a 95% exposure to global revenue. So getting global exposure for local investments. Now, we obviously want you to be able to, we want clients to invest in that because it'll help us dilute our global exposure, and then we can reopen the funds. So to entice you to do that, we're opening up a new fee class. There's no change to the existing A fee class. The A fee class stays as it is, no performance fee, 37 basis points plus VAT, available in tax-free savings accounts. No change. We're going to launch a new fee class B, which will have a 0% management fee and a performance fee. So you only pay a fee if that fund outperforms its benchmark, which is the all-share index. So if you expect global companies with global exposure to outperform companies with South African exposure, then you want to invest in that, and you only pay fees when that actually happens. So we will be launching a marketing campaign on that shortly, and if we get some good flows into that, well, then we can reopen our global fund. So help us to help you. But that said, we continue to engage with the National Treasury to try and get those limits changed. Mike, thank you for the good wishes. All the best for you as well for the festive season in 2024. I appreciate that. John, I'm not too sure about the health innovation unit trust dividend yield. you're probably best to email admin at Sygnia.co.za to get an understanding of that. I think that that fund does have a dividend yield, even if it is small. Obviously, all costs of the fund are paid out of the dividend yield, so that was the first place that that dividend yield will be net of costs. I think of ETFs. I could be wrong there. Sorry, I'm not too sure exactly how that works. Mervyn says, if Fed cuts interest rates, would it have a greater effect on US equities, US bonds? It depends on why they cut, Mervyn. So if they cut interest rates because growth has slowed to a recessionary point, then they will cut rapidly and US bonds will definitely do better. If the Fed only cuts slightly because inflation has fallen in line with target and growth is still there, but just growth is moderating, then US equities will be better. So it all depends on the growth outlook. How slow does growth slow to recession or not? What does that mean for the Fed cuts? And that'll impact asset class outlooks. Brian asked, will the two-part system apply to pension and provident funds? Yes, Brian, the two-part system applies to everything. RAs, pension, provident fund, everything will be impacted by two parts. As I said before, that was going to be from March 2025. It got brought forward to March 2024, and now it's moved back to September 2024. But we'll keep you posted on when that happens. Thank you, Clive. Dave, the transnational fund is not a building block within the skeleton range yet. So our best view for global is still investing directly. If you have the money to take offshore in your capacity foreign allowance, or you are comfortable going into our foreign ETFs, that are still, you still get the best, most diversified exposure by buying the global ETFs, global funds. The transnational fund is for people in their RAs or LAs who are at the 45% limit and they can't get more global exposure. And so you from in a diversified direct manner. So you can still get it through this fund, but it's quite a concentrated portfolio. It's got 30 stocks. So you definitely getting global exposure, but it's more concentrated than going directly into MSCI World Fund or our international flexible fund or other global funds. So it has specific point or place. It's the transnational fund. For RAs, LAs, where you are maxed out, but for medical funds who also can't get direct access to global equities. No, Louise. So the transnational fund campaign will not be available to TFSAs. Unfortunately, any fund with a performance fee is not eligible for a TFSA. TFSAs are only for funds with no performance fees. So our Divi fund is exactly the same. Our Divi fund, you can invest in the A class, which is a very low fee. That's available in the TFSA. But on the Divi fund, there's also a B class where you pay no management fee. And you only pay performance fees when that fund beats the benchmark. Now, as you've seen in the short term, that fund has struggled relative to its benchmark because of how resources have really struggled. So people who invest in the B class are not paying any fees on that fund, and they will only start to pay fees once that performance catches up with the benchmark. So it sucks that fund has underperformed the benchmark, but at least you're not paying any fees in that B class. But unfortunately, TFSAs, the way that the regulations are designed is that a fund can only be eligible for a tax-free savings account if there are no performance fees. Thank you. That's a good point. Thank you, Craig. Louise, that's a great question. She says, as per regulation, investors over 55 will have the option to opt out of the two-part system. Will Sygnia offer this opt-out option? I actually don't know. I'm sure we will be. We should definitely, we'll try to. It all depends on changes to the systems, but I know that we definitely will attempt to. Now that we've got a bit longer to do so, I'm sure there will be. But I don't know exactly what functionality is going to be available by September. Certainly everything that is in the regs we'll do. Unfortunately, as you're aware, we haven't even received the regulations on two-pot, the final regulations. So we don't know what we don't really know what we have to do. So it's hard to say what we need to do, let alone whether we can do it by the deadline, because we're still waiting the regulations. So it's all a bit of a mess, unfortunately, on two pots. But it's a great question, and once we get those final regulations in, we will definitely keep you abreast of what is happening. Okay, that is our last question. Thank you, everybody, for joining today. It really is a privilege to be able to talk to you. Thank you for answering the polls. Thank you for the Q&A. Pumi, thank you so much for joining and for your insights. It was great to have you today. It has certainly made things far more exciting and interesting. I wish you all the best festive season, a good holiday, safe travels if you are traveling, and we will see you in the new year, 2024, rinse and repeat, and we start all over again, looking after our money, looking after our clients' money, but really hope that over the last year, we've been able to share some good insights and help you achieve your aims, and we will certainly aim to do the same in 2024. So thank you so much. All the best.
Thank you, guys. Cheers.